Hi, today we're going to go through all the latest Q2 earnings reports from the three big American banks. So that's Wells Fargo, JP Morgan Chase, and Bank of America. And it's going to be very interesting to see whether I'm still confident that my investment in Bank of America is holding up okay. And we all know it's been one of the craziest quarters of all time. So let's go see how crazy it actually was. And if you're new to my channel, well, welcome, and my videos about investments that anyone in the world can make. Well, as you probably know, American companies, they report their results every 3 months to the general public. And I think it's pretty great that we can get a quarterly update from the companies that we've invested in. Now, if we were to see 1 or 2 bad quarters now, it doesn't mean we should just sell off everything and put all our money in gold. What we need to do is we just need to keep calm and remember that it's just a snapshot into our long-term investment. See, I'm actually from a farm, and if my family, if we have a bad 3 or 6 month period, well, we don't just go and sell the farm because we know it is a long-term game. And if the business is well run, well, the good times will return. So this is something that has helped me as a stock investor because I treat the investments that I make on the stock market like it is my farm. Therefore, I don't really worry about little short-term things. Okay, now today I'm going to go through Wells Fargo first, then JP Morgan Chase and Bank of America. So I thought I would start with the latest results from Wells Fargo because there is a lot happening here with Wells Fargo. Now, before I actually get into the actual details about their reports, well, there's actually been a class action lawsuit filed against Wells Fargo by their own shareholders. And look, this time might be different, but generally when this type of stuff happens, which it actually happens more often than you think, well, nothing much really comes of it. Now, something you'll need to understand is that Wells Fargo has most of its business coming from the consumer segment. So think of things like mortgages and things like that. Well, unfortunately for Wells Fargo, the consumer market has been hit probably the hardest with the lockdowns and the layoffs. So it was probably fair to assume that Wells Fargo, well, they were going to have a pretty rough quarter, and they did. Now, let's talk about the dividend. And a lot of people have invested into Wells Fargo over the past 6 to 12 months because of the dividend. So I think it is big news that Wells Fargo in their latest Q2 earnings report have reduced their dividend down to 10 cents per share. It was 51 cents per share. So that's an 80% reduction in their dividend. So it is very significant. But before you quickly go and sell all of your Wells Fargo shares, I actually don't think it's absolutely a bad thing. So let me explain. See, the company is going to save a lot of money by cutting that dividend, which means they can use the money to strengthen up their balance sheet. And we have to remember that we are in unprecedented times. So I think the idea to strengthen up the balance sheet is a pretty good and warranted idea. And when the United States, well, eventually recovers, I do think that the dividend will grow again and it will come back to some sort of normal level. But for all of those investors who were wanting a stable dividend that Wells Fargo had been providing, well, that just got burnt. Now let's turn to the revenue numbers, and it was down 17% from this time 1 year ago. But from my opinion, I think that was pretty obvious, right? Because this time 1 year ago, well, the US was moving along nicely and unemployment was at record lows. But then the next big thing we saw from the report was that there was a $2.4 billion loss for the quarter. Now, I know a lot of businesses are going to take heavy losses in Q2, but the best businesses and the ones that I like to invest in, well, they're not going to be taking the losses. See, the mistake that Wells Fargo has made was that they actually just misjudged the severity of the crisis. But trying to predict how bad the crisis was going to get in America, well, that was going to be really hard to do. So I completely understand them misjudging it. But what I think the crisis has actually uncovered about Wells Fargo is that they don't have the strong multiple revenue streams like the other banks do. So their losses were heavy. So here's what the CEO, Charlie Sharp, had to say. He said, "Our view of the length and severity of the economic downturn has deteriorated considerably from the assumptions used last quarter, which drove the $8.4 billion addition to our credit loss reserve in the second quarter. We are extremely disappointed in both our second quarter results and that despite the crisis, our franchise should perform better." Look, and I know some people out there will tell me that, well, Wells Fargo is just too big to fail and the government's going to keep propping them up anyway. But that might be true. I just don't think they're the best bank out there. And people will also say that it's good investing philosophy to buy quality companies where no one else wants to buy them. And I like that idea generally, but we want to still buy quality companies, and I just don't think Wells Fargo is that good of a company. Okay, maybe it's not the best of companies, and if the share price was to get to, say, I don't know, $10, well, I would probably be quite interested. But their share price, I don't think represents a bargain deal at the moment. And with that quarterly loss, well, I don't think I'm going to be investing anytime soon. And by the way, the share price right now is about $24, and this is late July. All right, so that was Wells Fargo. So now let's go take a look at JP Morgan Chase and see what was happening there. Okay, now JP Morgan, well, they actually had a pretty good earnings report. After just listening to what happened with Wells Fargo, well, I expected that the other banks, well, they were going to be going through a tough time as well. Now, it's not like JP Morgan are flying in this current period, but comparatively, their results look pretty good. So the big thing to come out of their earnings report was their record-breaking revenue. That's right. Q2 was a record-breaking revenue quarter for JP Morgan. This revenue number hit $33.8 billion, which is up 15% year on year. They also were able to boost their reserves by nearly $10 billion to help mitigate the risk of a lot more defaults coming in the future of their loans. All of this sounds counterintuitive, right? Now, it wasn't all blue skies, and their loans did take a hit, and their earnings per share also took quite a big hit as well. But overall, the Q2 results from JP Morgan, well, they just blew past what the analysts were predicting. Now, these analysts are full-time professionals, so they're sitting around in Wall Street having meetings every day and talking about the industry and talking to people who work for JP Morgan and Chase. So you would think with all of this information that they should be able to get a pretty close idea on what's going to happen each quarter. But often, they're not even close. Now, for a lot of these big companies, there's more than one analyst. So what you could do is take an average of what all the analysts are thinking, and that's not a bad idea. But honestly, time and time again, we see that even this approach, well, it's not very accurate. Now, I shouldn't be too harsh on the analysts. Like, they put a lot of effort in, and I'm sure predicting the future is really difficult. Now, I don't have a problem with the analysts, but where I do have the problem is that I think that investors, well, too many investors, follow what the analysts say and their predictions too closely. All right, that's enough about the analysts. Let me get back to the results. Now, the reason that JP Morgan Chase had good results and Wells Fargo had bad results, well, it really comes down to one thing, and that is, well, JP Morgan Chase have strong multiple revenue streams. So for JP Morgan, well, their loans went down 4%, but their investment banking sector, well, it went way up. And for those who are interested in the dividend, well, JP Morgan kept the dividend the exact same at 90 cents per share. So again, unlike Wells Fargo, who had to seriously cut their dividend, JP Morgan could keep it the same. So I actually think there's a really good lesson here. We don't want to chase a really good big dividend like Wells Fargo had. What we really want to do is we want to focus on a really good company. Before Wells Fargo made their cut to their dividend, it was sitting at around about 8% yield. But with a little bit of investigating, it was pretty clear that that dividend wasn't going to be sustainable. All right, let me brag a little bit here. Go back and watch my video, which is called Which Bank is Best, where I even said that the Wells Fargo dividend is probably not sustainable. Now, on the negative side of the JP Morgan results, well, they did put out a bit of a negative warning for the future. See, they are concerned that a worst case scenario could see $20 billion loan defaults for them. That would be completely unprecedented. They said they can handle this situation and are hoping that the world economy improves rather than declines in such a bad way, but they are preparing for this worst case scenario. Now, I don't think it is a sign that they think really bad times are actually coming. I think they just want to be prepared if this extreme downturn was to happen. Now, rationally, this is good management to be so open with their shareholders about the potential risks of the future. And also just telling their shareholders how they're preparing for this possible worst case scenario, well, it's not a bad move. But the problem with this type of statement is that it scares people. And scaring people, well, it makes people do sometimes stupid things like getting all their money out of the bank and putting it under their mattress, and they stop spending completely. And it also means that people will sell their shares. So I'm very interested to see whether JP Morgan's share price gets punished for this statement. If so, I would be a buyer at about these prices. The first buy at $75 and then a second buy, hopefully at $60. These are about the prices I wanted to buy JP Morgan a few months ago. Again, take a look at my previous evaluation of the American banks for more information. Okay, now we're going to move on to what you've all been waiting for. Well, what I've been waiting for anyway. So let's go take a look at Bank of America. Okay, now straight into some of the results. And revenue for Bank of America declined about 3% from this time last year. Earnings per share came in at 37 cents per share. And that's actually a big reduction to where it was 1 year ago, where it's fallen about 50%. Now, this doesn't sound great so far, and the analysts were thinking that the revenue was going to be a little bit worse, and they thought the earnings per share was actually going to come in at 27 cents per share. So I just want to highlight how big of a difference that actually is from what the analysts were thinking. The analysts were saying that it was going to come in at 27 cents per share, but it actually came in at 37 cents per share. That's really not even close. This difference, I think it's a pretty substantial miscalculation by these so-called experts. So please, don't believe the analysts. Use them as some sort of guide, but that's it. Don't follow them too closely. The thing that's actually hurting the banks that I haven't touched on yet is actually just the lower interest rate environment that's really hurting the bank's profitability. Now, like JP Morgan Chase, well, Bank of America had actually a really strong uptick in the investment banking side. They actually broke records for the quarter where it was up 57%, and they made about $2.2 billion in fees just from this investing banking sector. Now, interestingly, Bank of America actually doesn't have the loan reserves even close to compared to what Wells Fargo and JP Morgan have. Maybe Bank of America don't think things will be anywhere near as bad as what Wells Fargo and JP Morgan think. Or maybe they're just not being cautious enough. And as a shareholder, that's a little bit concerning. As a shareholder, I actually would prefer them to be a lot more conservative in their approach and have bigger cash reserves up their sleeves just in case worst case scenario was to actually happen. Well, happen again. So here's what the CEO of Bank of America, Brian Moynihan, had to say. He said, "In the most tumultuous period since the Great Depression, we delivered for our clients and our employees, our communities, and our shareholders. Strong capital market results provided an important counterbalance to the illness-related impacts on our consumer business, and our industry-leading digital capabilities allowed us to support clients amid difficult working conditions." Now, CEOs are supposed to be optimistic people, but a lot different tone to what the Wells Fargo CEO was saying. So overall, my opinion about Bank of America, it hasn't really changed. I still like the business long term, even though I would prefer to see bigger cash reserves. I do think if Q3 was to roll on and things were starting to get a little bit worse, I do think they can adjust. And the big positive for Bank of America, just like JP Morgan, well, they weren't going to take a loss this quarter, just like Wells Fargo, because they have strong multiple revenue streams. Now, if you remember from my last video about the banks, I said that I think I like JP Morgan as a company maybe slightly more than Bank of America, but the Bank of America price, well, I'm far happier with. And depending on what day you're watching this video, here in late July, well, the price is around about $23.50 right now. And at this price, well, I think it actually is a pretty good entry point into the company. Now, I first invested at around about $22, I think, something like that, and I'm definitely going to be wanting to invest more at $20. And maybe Q3 is a really bad quarter for the share market and we see prices lower than $20. So happy days and I'll be accumulating a lot more. Now, please don't take my word for it. Do your own research and know what you're investing in. Because already there's just far too many people who are investing in companies when they have no idea what it is they're actually buying. Please at least spend more time researching into the investment than you would, say, buying a laptop. That's a good start. So overall, I do think the banks are a good investment for the pending recovery. We're not going to be in a recession forever, and as interest rates improve, well, the big winners are the banks. JP Morgan and Bank of America relatively are performing actually not that bad. So considering the current crazy environment that we are in, well, I think they're holding up pretty well. And the reason they're holding up well and Wells Fargo isn't is because of their strong multiple revenue streams. And I still think if I was starting a brand new portfolio, one of the first companies that I would want to invest in is probably Bank of America, more than JP Morgan Chase, because the Bank of America price just gives you far more upside. Now, similar to this style of video, in the future, I'm planning to do some sort of quarterly update on some of the other companies that I've invested in. I'll do updates on Microsoft, Google, Skyworks, and Amazon. Then after that, I'll do Visa, MasterCard, and PayPal. Then I'll take quite a deep look into Apple and Facebook as well. Then the oil tankers, Euronav, DHT, DSSI, and TNK. And finally, I'll do Middleby, Berkshire Hathaway, and Alibaba. If these types of videos interest you, well, please subscribe to my channel and leave your questions in the comment section below. And remember, you're in control of your own money and only invest what you can afford to lose. And of course, only look at these videos as some sort of entertainment. Don't look at it as financial advice. And a big thank you for all of those who've stayed right to the end of this video. I appreciate that a lot.